By way of introduction, and Art said I could lead off the introductions, my name is Kevin Vandoler. I think many of you already know me about me in the crowd, but I'm a consultant at AndCo, and I'm based in Austin, Texas. And I started my career as a plan sponsor. Joined when my wife moved me to Chicago in the mid-'90s. Joined a small little consulting firm called Ennis Knupp. We sold in 2010 to Aon, and that's when the best decision of my life was made, was when I bought land in Texas. And indeed, that's where I've been hailing from ever since. And proud to be part of the AndCo family of investment consultants. It's a quick snapshot of myself. Sitting to my left here is Steve Chicane, and he is the managing director of Constitutional Capital, where he's responsible for screening, evaluating, negotiating, and monitoring credit investments, and he's also a member of the firm's investment committee. Prior to joining Constitution, Steve was the founding partner of one of the founding partners of Morgan Stanley Credit Partners, and has his MBA from Columbia in finance and undergrad from University of Pennsylvania. Now we're going to say a little fun fact about each one of the speakers, so you can talk about it while you're at the social hour. A fun fact about Steve is that every Halloween he dresses up in the same costume, and it's Darth Vader. So you need to ask him why. Dan Brady is sitting to his left, and he's the chief investment strategist for PNC and leads the team that essentially sets tactical asset allocation decisions for their clients. And he also is responsible for thought leadership that is produced out of the team, and is a member of the firm's investment policy and research committee. Dan has an economics degree from Ohio State and hails from Cleveland. And a fun fact on Dan is that he is a member of the Society of American Baseball. And when I asked him to explain a little bit more, all he would say is, think Michael Lewis and Moneyball. All right, last but certainly not least is Zach Ellison, is the founder and CIO of Applied Real Intelligence, a venture debt investment firm focused in on providing solutions for innovative, high-growth, VC-backed companies that, as Zach likes to refer to them as, recession-resistant sectors and underserved regions. Now, the fun fact about Zach is that he loves to be a student, and you'll understand why in a moment, because he holds an MBA from University of Chicago. He's a fellow Stern graduate like myself with a master's in risk management, and he clearly loves taking exams, because not only did he complete his CFA, but he's also a Kaya charter holder as well. And in the last 2 weeks, he's been completing his PhD because his slides were late, and he said, well, the reason why is because I've been studying so hard for my doctorate. So that's a quick summary of the esteemed panel to talk about this very important topic called inflation. Now, maybe we can go to the first slide, and here's a consultant's viewpoint from a rear view mirror perspective. There's a lot of numbers and a lot of green bars and blue bars, but essentially on this slide here, it shows the green bar is the S&P 500 for money, and the blue is the bonds, rates of return during periods of high inflation. And you can see the 2021 there is in the bottom right-hand corner. What's fascinating about this slide is it explains a lot of the market activity over the last 6 weeks in terms of a significant recovery in market valuation since the middle of June. And the bottom right-hand corner that shows during periods of high inflation, the next 12 months typically has on average had a rate of return of stocks of roughly 7%, and bonds roughly about 3%. And for my fellow investment consultants in the crowd here and plan sponsors who digest their capital market assumptions, that was pretty close to what we were saying in the middle part of last year at this time, what we expected the capital markets to deliver. Now, that's pure luck for the most part, that we get median right on what actually happened in the 12-month period, but it's still something to think about in terms of that it's not all bad when we have this unexpected inflation from a stock and bond perspective. But now I'm going to turn it over to the experts and turn it over to Steve. He's got a few slides to warm things up, and each one of the fellow panelists have a few slides. And then about 30 minutes into this discussion, we'll start turning it over to the questions from the audience. So start thinking about your questions now. So Steve?
Sure. Thanks, Kevin. So just by way of background, I work in the private credit group at Constitution Capital Partners. So what we do is we finance middle market private equity-backed companies. So when there's a leveraged buyout, an acquisition that needs to be financed, or a recapitalization, we will provide first lien debt, junior capital, mezzanine capital, and small equity co-investments as well. So we have a private portfolio of about 40 names across a few funds. Our fund, because we're investing in private companies, has seen over the last 18 months the effect of inflation on companies here in America, especially in the middle market. So what we saw last year was that price hikes implemented by companies were very slow to take effect. Companies were initially affected by labor troubles. People were switching jobs. They were requesting a higher pay. And in addition to that, there was commodity inflation, transit inflation, and energy inflation. So a lot of the price hikes, like I said, took some time to implement, and we've seen the effect this year with a great deal of revenue growth. Labor was the first thing that we saw in terms of stabilization. A lot of the companies out there said, okay, we can't afford to be losing employees, so let's be one of the better payers out there and maintain our workforce. So that has stabilized. But as we've gone into this year, we've seen continued pressure on margins. So revenue growth has gone up pretty significantly this year. There are a couple of studies by Golub and Lincoln International with strong revenue growth, but margins have contracted. So EBITDA growth has trailed the increase that we've seen in revenue. So we expect a little bit more trouble on the cost side for the remainder of the year. So that said, what do we think is a strong investment thesis in an inflationary environment? So as you know, the Fed has been raising rates pretty dramatically. So we think middle market, direct lending, and private credit is a strong strategy. So the obvious reason first is floating interest rates. So as rates go up, we're getting paid more interest on our underlying investments. So if you look at the beginning of the year, LIBOR was only about 20 basis points. It's currently about 3%. So companies are paying us more cash and interest. It helps our returns, but it's not free money because those companies have to use more of their existing cash flow to pay us, and that's less to reinvest in our business. Given we're a private asset class, there are low default rates and the existence of covenants. So because we are a relationship lender, we have covenants where if the company is missing its numbers, we can talk to them early on, work out a solution, maybe increase rate, get paid a fee, or maybe the sponsor can put in equity to solve the problem. Our diligence is private equity style, so we're not just relying on public filings. We're talking to the CEO, CFO, talking to customers, suppliers, getting legal diligence and accounting diligence as well. And then finally, we have lower leverage levels than the large cap market. So the middle market tends to see half a turn less of leverage, so more conservative capital structures. And when there's a buyout, sponsors are putting in more equity. So generally 45 to 50% of equity, which is junior to us, which helps a lot.
Hey, Steve, can you just define middle market?
Yeah, so traditionally middle market has been, kind of $50 million and below in EBITDA. That definition has increased now to about $100 million and below. And a lot of that, the reason for that is only large issuers have access to the high yield market and the leveraged loan market. One of the lessons learned in the financial crisis is that investors want liquidity. So if something goes wrong, they want to get out of a position very quickly. So if you're only in a $200 million bond, there's not a ready buyer for something that small. So now you're seeing high yield debt with average issue sizes north of $1 billion. So it's only the biggest and largest issuers that have access to the public market. So the smaller issuers have to go to private lenders like us. So if we look at the leveraged loan market and the private debt market, through the first 6 months of the year, leveraged loans was the best performing asset class amongst a number of different leveraged finance markets. So distressed debt fell 24%, investment grade bonds down 14%, treasuries down 9%, but leveraged loans, because of the floating interest rate, was down only 5%. And as of Friday, we were only down 70 basis points. So the market recovery in July and August has really helped the returns in leveraged debt. If you look at yields over time, the Cliffwater Direct Lending Index is a good proxy for what we do, and you see that there's a substantial premium in private credit versus leveraged loans and high yield, and that premium is anywhere from 200 basis points to 400 basis points. So this data is through the end of March. The 6/30 numbers haven't come out as of yet, but you are getting significant premium because of the illiquidity in the asset class. Also on the right-hand side, you see annual returns in the CDLI, the private lending index. So you're getting very strong returns of close to 10% annually with very little volatility. So you could see the other asset classes, it's nearly a straight line going up. So as you take more risk, you expect more return. But for private lending, you're getting very attractive returns with very little volatility. And then finally, the correlation of leveraged loans to other asset classes. So obviously we are more correlated to high yield debt, but there's negative correlation to treasuries, which are very interest rate sensitive, and then very little correlation with equities and investment grade debt. And then finally, as I said, the Fed is raising rates dramatically to fight inflation in this environment. But if we look at the last 4 cycles of aggressive Fed tightening, leveraged loans have outperformed other major asset classes. So equities in the last 4 cycles rose about 6% on average, whereas leveraged loans rose 7%. That's a function of the floating rate component of the underlying instruments and the protections you have as being more senior in the capital structure.
Thank you. So it's all about the floating rate structure of these instruments.
Exactly.
Great. Dan?
All right, thanks, Kevin. I'll need the clicker. So, good afternoon, everybody. My name is Dan Brady, Chief Strategist at PNC, like Kevin mentioned. Which one is the button?
It's the green button.
Green. Okay. Already did it. So, as a multi-asset universe strategist, I'm going to be talking about a number of different asset classes, given the unique environment that we are really facing for this year. So on the chart on the page here, what we're showing is the S&P 500 and the ag. So also, like as Kevin mentioned, not only do I like baseball, but I love music. I would say for this year, you could describe it as the nowhere to run, nowhere to hide. Martha and the Vandellas, anybody? That really just sums up this year, where it's been extremely painful for long-term investors, where equities obviously in a bear market. But you also had fixed income investments down. What made that even worse was in the first quarter, you had bonds underperforming stocks. And so it was just this very crushing period for investors. But I would caution just comparing that between what we've seen in prior cycles and where we are today, where I know the topic is diversifying strategies for an inflationary regime. But it's interesting if you look at what was going on in some of these other periods, where you had not just 1, but 2 quarters, where you had both stocks and bonds down for the quarter. And what do these periods all have in common? It was similar to what Steve just pointed out. So I would point to 1994 as an example. It was actually when the Fed was raising rates. In inflationary regimes, just as Kevin was talking about with capital market assumptions, you can still get positive gains in those periods. But it's really distinguishing between the two about a Fed focused on raising rates and in a tightening cycle versus just purely an inflationary regime. They can be very different. And a lot of what's happening this year is actually that exact point. I would even point to what was happening last year when you saw inflation really start to increase. You actually had fixed income markets deliver positive returns. And so you have to know the regime that you're in. Is it just purely inflationary? You can still find pockets of opportunity within that. There's a number of asset classes that can provide positive returns. Or is it being driven by the Fed and the rising dollar and these other extenuating forces that are going to be impacting your portfolios? That's really the key difference. And then what's also important on the slide here is what comes next. And it's very similar to what Kevin was saying. Most of these periods, you actually end up with positive returns over the next 12 months. And so it's that key differentiator between inflation versus the Fed and the policy just going way too tight with tightening financial conditions. Obviously, we'd have much more to say after the Jackson Hole meeting this Friday, so unfortunately, left my crystal ball in my suitcase, so I can't say what Powell plans to say on Friday. But what we can point to is in these periods of very aggressive rate hikes, look to what comes next, and it's typically positive returns for markets.
Would you say both in nominal and real terms, or just largely nominal?
That's actually a good point, which then brings me to the next slide in terms of focusing it on the nominal side of things. Because why are we in this period where the Fed is raising rates? You're seeing pockets of opportunity, though. It all just goes back to the inflation story. But not only that, it's the type of inflation and what's actually driving inflation right now. And I bucket this out between the top chart where you can see what's driving US inflation. So yes, it's obviously food and energy prices, but what we've seen lately is goods and services inflation starting to come up, whether that's the housing market that you've seen dramatically come up very recently, or it's on the services side of the equation. So that's really what's going on in the US. But as a multi-asset investor, I have to look just beyond the US and other asset classes. And so what we're showing on the bottom are the drivers of inflation, not just within the US, but across Europe and the UK. And it's fascinating in our mind because we're kind of nerds about this stuff, but you can see what's driving inflation in Europe and the UK. It is dramatically focused specifically on energy, specifically to food prices. Now those are transitory drivers of inflation. You cannot see those continuing to go up forever without seeing a slowdown in the market. And so now here we are where the UK, you now have over 10% inflation, but so much of that is just simply being driven by the price of natural gas, the price of food, and that's what's driving inflation there. So to think that these inflation drivers are just the same across the globe, it's going to have a dramatic effect about what's driving your equity returns going forward. If it's just purely food and energy, that's very different than what we're seeing in the US. So again, as a multi-asset universe investor, really have to keep that in mind about what are these drivers of inflation and what's going to give you those positive real returns. Because if you're just focused on US inflation, you're going to miss the bigger picture about what's happening across the globe.
All right, Zach. Let's talk about what's happening in the venture capital world.
I was going to talk into this one.
And is
My hands are full.
venture cap, the debt, is that a really good inflation hedge?
Yeah. So I want to take a half step back. I just want to ask everybody in the room, who is interested in alternative assets right now? Just raise your hand high. Maybe like 25, 30% of the room. How many people are interested in learning about private credit? Okay, we got like 5 people. That's great. All right, so I'm going to speak to you 5. So let me take a half step back. So what I do is I run a venture debt fund. And this is a strategy most people have not heard of, but you're going to be hearing a lot about it. Blackstone just announced they're doing a $2 billion venture debt fund. What's great is they will not compete with us because they're going to be writing much bigger tickets, but it legitimizes the asset class. So now all the consultants and folks that haven't been paying attention are forced to, which is great for me. There's also news out there that KKR, this is public, is looking to buy some venture lenders. So you basically have maybe the 2 most relevant private equity, private credit funds of all time, both going all in the space. 4 years after I did. So I bring this up because it's relevant. The game's changing. 2 years ago, I talked to people about venture debt, and they would look at me like I was crazy. And now they're like, hey, you've got the best strategy in the market. So let me explain what venture debt is. But I just want to take a half step back and just tell you a little bit about my background, because if you don't know who I am, then why do you care what I have to say, right? So long story short, I grew up in Boston, single mom. My dad was never in the picture, low income, and used education as my way to get out. So to Kevin's point earlier, I've got 2 master's degrees from University of Chicago, where I did my MBA, NYU Stern, where I did an MS in risk management, and I'm now a Florida Gator, where I'm working on my doctorate in business administration. I'm also on the board of CFA Society in Los Angeles, and on the board of CAIA, which is the Chartered Alternative Investment Society in Los Angeles as well. I also am the West Coast Regional Director for the Hedge Fund Association. So long story short, I've got all the academic chops, but what's more important is that I was in the fixed income space for 15 years at 3 multi-trillion-dollar asset managers. I was underwriting leverage loans during the credit crisis when everybody was losing their shirt. I was writing, underwrote $6 billion of TMT leverage loans, didn't lose a penny. This was at Scotiabank, one of the top performing banks globally during that time. Then I went on to Wall Street, where I was a bond trader and CDS trader at Deutsche Bank, back when we were #1 in fixed income. My team led the biggest bond deal of all time at that point, which was Apple's $14 billion deal. That was traded by the guy that sat right next to me. same distance as we are. So I bring all this up because I had a great job, right? And then I went to Sun Life, which runs 1.4 trillion and managed 25 billion in bonds. And
You like those Canadian companies?
Yeah,
right?
I love Canada. Outside of Texas and Florida, Canada's my number 3. So long story short, I've been an underwriter, I've been a sell-side trader, I've been a PM. Again, all these shops are multi-trillion dollars. And I saw a huge opportunity in the market. This was about 2018, I started thinking, corporate bonds are gonna go the wrong direction for the rest of my career. And we're seeing it now. So everything that you're seeing, that was obvious to folks that were in the market. It was gonna happen, it was just a question of when this was gonna blow up in your face. So now we've got inflation, we've got rising rates. These are not going away anytime soon. It's very, very hard to tame inflation. Rates are going up, your fixed income portfolios are gonna continue to get the crap kicked out of them, quite frankly, in my view. So I thought, where can I make money, and where can I make money for my investors going forward in fixed income? And I looked at every strategy in the market, and around that time, a mentor of mine came to me and he said, Zach, you should really look at the technology and innovation space, because a lot of the best startups in the world, the ones that have already raised hundreds of millions of dollars in equity, are willing to pay a lot of money, a high interest rate, to borrow money. Because for them, it's still cheaper than selling more equity in their business. And so if you think about this intuitively, if you run a company and you're kicking butt after spending 10 years eating ramen soup in your one-bedroom apartment, the last thing you want to do is sell equity in that company, right? You're like, no, dude, give me some debt, give me some growth capital, but don't take any more of my equity, right? Everybody should be nodding their head right now, right? So this is what's happening in the market. You've got all the money going into funding innovation. These companies are killing it. They're making tons and tons of money for their investors, but a lot of the founders are giving up huge ownership stakes to accomplish this growth. So now they're coming to me and to other venture lenders, like Blackstone and others in the space, and they're saying, we will pay you 15 to 20% per year if you lend us money. And there's almost no risk because we've already got tons and tons of money that we've raised from the VC firms. So essentially, what venture debt is it's loans to the best VC-backed companies in the world. And you get a 15% debt coupon like clockwork, and you've also got equity warrants in all the deals. An equity warrant's just the right to buy stock in this company. And typically we get 10-year equity warrants. So you've got 10 years to buy stock in these companies that are the fastest growing on the planet. So this is what venture debt is. We'll talk about it more later, but suffice it to say, we didn't even get to any of my slides. Suffice it to say, we're typically lending less than 15% against the value of the company, the enterprise value. So all the folks out there that are used to hearing this term LTV, loan to value, in real estate you might hear 60, 70, 80%. We're lending 10 to 15%. That means these companies could do everything wrong, screw the pooch in every single way, and we're still covered. And that's why historically the strategies produce incredible risk-adjusted returns. We don't have that slide up here, which is terrible. There's a slide, let's see if I can go back. There's a slide I usually have in the deck which shows the annual yield from the venture lenders going back to 2005, and it's like 15% plus or minus 1% every single year. It's like better than your Rolex if you're, or your fake Rolex if you're me. If you ever, it's that consistent, right? The returns are 15% every year plus the equity kickers. So I don't want to take too much more time, but let me just say, here's what it is. It's 3 to 4 year loans. Typically they're paid down in 2 years. Typical cash interest rate's about 15% per year. They're all floating rate loans. So I agree with you that floating rate is where you want to be. 100% floating rate, and you've got these long-term equity warrants. So it's the two best inflation hedges you can get in the market, floating rate plus long-term call options, right? You're getting access to the same companies you would get access to on the VC side, except later stage, and they're de-risked because we're putting them in a debt package. So you don't have to wait 10 years to maybe get paid. You're getting paid every quarter. We get interest in, we pass it to the investors. And then at the back end of the fund, we monetize the equity warrants. So the highlights are great risk-adjusted return. These loans are senior secured. You've got a first lien on all the assets. Very low loan to value, right? Very low risk there. Covenants on all the deals. low correlation to the markets. I could care less what the bond market does in any given day. It doesn't affect how our loans do, right? There's very little correlation. Bonds are down 14 to 20% this year, depending on what their duration is. Venture debt's up like 6-7% year to date, killing it. And then last but not least, for folks that do like to co-invest, this is where you see the deal flow. People come to me every day and they're like, hey, I want to see the deals you're doing. How do I get in? I want to know because it's relevant. These are the companies that are changing the world, right? These are the companies that you don't know about yet, oftentimes, but that you're going to know about when they go public in 3 to 5 years. So with that, thank you for the time.
So our goal was to be a little edgy in relationship to inflation and how to perhaps provide some defensive opportunities in relationship to what we're experiencing right now. Maybe we can just, Zach brought up a really interesting point called like an innovation asset class. I probably wouldn't clear the CFA Institute's requirements of a definition of an asset class, but perhaps maybe we can think about that a little bit more collectively as a group. And what does an innovation asset class look? And I'm going to do it a grab ball to any one of the 3 panelists here. And I got some additional follow-on questions.
Well, I can tell you in our asset class, there's been an increase of lending to unprofitable software companies, and it's been
Unprofitable.
Right. So not
doesn't sound good.
Not good,
It
but
sounds like 2000.
exactly.
All right.
But you see a lot of the public.
But it's different this time?
A little bit.
Okay, got it.
So what we're seeing now is a lot of public to private transactions in the software space. So you see guys like Thoma Bravo and Vista Equity buying very, very large software companies. But the way these loans are being structured to a certain extent in the larger space of the market is on a recurring revenue basis. So what they're doing is they're picking the interest. So they're allowing the company not to pay cash interest for the first 2 or 3 years, so that they can drive growth. So as you know, a lot of the software companies are spending heavily on their sales force and increasing their market share. So that minimizes their cash flow in the near term. So they're allowed to pay the interest in kind, but then after 2 or 3 years, it flips to cash pay, and then you have traditional covenants involved. So there's been a shift in the market as more sponsors are looking at the software and technology space with innovative structures in our deals.
So that would fit within an innovation asset class?
Within the traditional middle market.
Would that fit more like an opportunistic, like a investment policy allocation, something that doesn't neatly fit in a stock, bond, or private equity or real estate portfolio?
So I still think it fits under your traditional leverage loan portfolio.
So it's in the fixed income policy?
Still definitely within the fixed income policy, but more of a structured product within that asset class.
All right.
Yeah, so I just have a couple of thoughts on this. When I say innovation is an asset class in the sense that maybe it doesn't fit neatly into somebody's bucket, but in terms of, think about what's driving value, right? This is what I ask people, like, use your intuition. Where is there money being created and made for you in your pensions, right? It's not in these old school brick and mortar businesses, it's the tech sector. Even large cap tech. What do you think drives S&P performance? Apple, Facebook, Microsoft. These are tech companies.
But they've done very well over the last decade.
Yeah, no, so my point is that innovation is what's creating value. And this has been true forever. You come out with a new idea, you generate money. Ford had the Model T, it made a lot of money for a long time, right? Point is, there's a lot of ways to access these innovative companies, and it's the investor's choice or the allocator's choice as to how they want to access it. You can go the equity route and go large cap tech. I'd say that's innovation that's part of the innovation asset class. But you can also go VC at various stages. You could be early stage equity VC, or you could be late stage growth equity. You could do private equity, right? You can do venture debt. You can do other types. So there's ways to access this, and what's great is now investors have the choice. It's like a menu of options that they didn't have 5 or 10 years ago. Like, venture debt wasn't an option for 99% of the people in this room.
Why has venture debt not been on the radar before?
It
was missing Zach?
It's an emerging asset class. I mean, yeah, it was missing May. No,
okay.
It's an emerging asset class. Like, think about if you ask the same question about venture capital in 1990 or high yield bonds in 1988.
Yeah.
It wasn't called high yield then, it was called junk bonds. And everybody said, this is too risky, don't buy it at any price. And Howard Marks and Mike Milken came along and said, you guys are fools. And now they're billionaires and legends, and everybody in this room has high yield in their portfolio, right? That's where venture debt's headed. And just, for what it's worth, there's a lot of misconceptions about our asset class, and a lot of people that aren't in it like to talk about it, which it's tough for me because I have to spend most of my time re-educating people. But we don't use PIK interest. We get paid just for what we do. We get paid straight cash, like dollars, not cryptocurrency. So
that's another panel. So we can't go down that path.
So you may have heard this term PIK interest. That's called pay in kind. It's basically interest that's not paid in cash. It accrues and it's paid on the back end. Some people will use this in certain types of structures to preserve cash burn. That's what you were alluding to. In venture debt, that's actually not how it works. Only about 15 to 20% of deals have any PIK interest component, and it's usually just a couple percent a year as like an added bonus. 12 to 15% is what you're getting in cash every single quarter, and then you get additional fees on the front end and back end and the equity kickers.
Dan, would you like to add anything to the innovation
I would
asset
say,
class?
yeah, just with people raising their hands about alternative asset classes and the like.
There was only 5, right? Or was that?
Right. I think it just goes to show that there's this need for thinking more along the innovative components. You have to forget about the mindset of the traditional Morningstar style box about growth, value, large, small. That's the old days. That's
what investment consultants set up. Indeed.
So one of the other ways is just thinking about it more thematically and just thinking about innovation as a theme rather than style investing. And I think that's where there's a lot of interesting opportunities that it's focus in that segment, because you can't bucket them traditionally, so it's a little more challenging for a multi-asset portfolio, but we think that's really a place for investors to really consider in this sort of an environment.
Well, the panel's done a lot of talking. I want to just open it up to the audience. Do we have any questions for this esteemed panel about inflation and these interesting ideas that they are discussing? So maybe, Zach, you can repeat the question.
Yeah, I'll repeat the question. So the question was, a lot of founders want to utilize venture debt to minimize their equity dilution. How are these equity warrants that we take out of the money? So it's a great question. So first of all, there is a little bit of dilution, clearly, but it's a lot less than a straight equity transaction, just to be clear. So it's not 100% non-dilutive, clearly. These equity warrants are actually typically in the money. Oftentimes they're penny strikes, meaning I have the right to buy shares in the company for a penny. That's negotiable. Sometimes companies that have more negotiating power will want a higher strike price, but typically we're able to get pretty low strike prices. And typically we're taking about 50 basis points, anywhere from 50 basis points to 100 basis points in potential equity.
Okay, so the ratio between the amount of debt they're getting and the amount of warrants they're giving up is small, and that's why they're
Correct. So the question was basically thinking about how much debt they get versus how much equity they give up. And typically, the warrant coverage, which is warrant coverage is defined as the value of the warrants relative to the size of the loan. So say we make a $10 million loan, we typically will get about 10% warrant coverage on average, meaning we get $1 million worth of equity warrants. And that's a great question. Thank you.
Yes, so we're going to go to a question over here on the right, but Zach, can you put us to the original slide, the first slide? Yeah. So the question on the right-hand side over here, yes.
Yeah, good question. So it is definitely a long-term opportunity for a number of reasons. So as I alluded to earlier, only the largest issuers have access to the public markets. So the publicly traded leverage loan market and the high yield market. So the middle market really has to turn to private lenders. If you look at the amount of dry powder in private equity funds that are $2 billion and below, so what I said earlier, kind of focus on that 100 million and below of EBITDA, there's about $1 trillion of dry powder that has to be put to work over the next 5 to 7 years. And if you use the 50% equity contribution as a proxy, that means there's $1 trillion of private debt capital that has to be put to work to finance those transactions. So I think not only that, but also over the last couple of months, you've seen the large banks exit the underwriting new LBO transactions, because what happened was they were underwriting deals that had long tails to them, and they're now syndicating them and taking massive losses. So the risk managers, as we saw back in '08 and during other periods of volatility, pull back on underwriting. So there have been stories that 100% market share of new underwritings have gone to private lenders, and you're seeing the likes of Blackstone and KKR with massive funds doing massive deals by themselves. So the private market really has a lot of legs to it over the next couple of years.
Any other questions? Perfect, in the back right corner with the blue. That affected what? Can you direct lending. How's the current market conditions where the bond market is screaming recession and the equity market saying everything's just going to work perfectly for Jay Powell?
I have thoughts on this after as well.
Okay, so go for it.
I could go. So in direct lending, what we've seen, as I alluded to earlier, a lot more has shifted to the private market. But what has happened is that underwriting standards have become more conservative. So we still have covenants in our deals, but even greater equity contributions in deals. Leverage levels have gone down significantly, and then also pricing has widened out 50 to 100 basis points relative to what we saw earlier in the year. Also, upfront fees. So we charge a fee when we underwrite a deal that we're getting another 50 to 100 basis points underwriting fee on those transactions. So not only are we underwriting more conservative structures, but we're getting paid an extra amount in this environment. And that tends to happen when you see volatility in the market.
Yeah, so just to echo Steve's points, definitely getting much better pricing, much more power in the negotiations, certainly. 6 months ago or a year ago, borrowers had all the power, right? And a lot of bad deals were done at that point, I think, by some folks, and that'll be proven out over the next couple of years, because a lot of the deal structures were pretty weak in terms of protecting the lender.
So you're saying the vintages of 2019, 2020 could be pretty poor?
I think that the vintages from 2020, 21, and will be bad. Yeah.
So it's like fine wine. So you'll say, oh,
Yeah.
I don't want the 2020.
Yeah, it's
send
like
it back.
bad grapes. I don't want
Yep.
those.
Yeah.
But I actually think the vintage for 2023 and probably 2024 are going to be maybe some of the best in the history of private direct lending. And I can speak for the venture debt ecosystem. So here's a crazy stat that will kind of put this in perspective. In 2020, 160 billion went into funding venture companies or venture-backed companies, so on the equity side. So there's 160 billion of capital put to work by VC firms in the US. That was an all-time record. Last year, 2021, that number went to 330 billion. So imagine you're at an all-time record of 160, and then the next year it goes to 330. It's crazy. It's like Babe Ruth, the next year, like somebody comes along and hits 150 home runs. It's crazy. So
is that a factor why the vintage may be poor?
Yeah, so here's what I think what's happening is, for us, it's the best thing that could ever happen. People say to me, hey, are you worried about the market? I'm like, worried? This is like God sending me like a gift basket, it's amazing. Because what we have is 500 billion deployed in the last 2 years, and all these companies are gonna need to refi along the way. They all need more money. And they typically, most venture-backed companies are refinancing every 2 years with another equity round, right? So we've got more companies than you can imagine. This is what we call a target-rich environment. Imagine a big bowl of cherries, as big as this stage, and you get to pick out the 12 that you want to eat, right? That's kind of what it's like being a lender right now. It's amazing. It truly is. Like, people use this term cherry picking. There's 3,500 venture deals done every year in venture debt. We have to do 12, and they're all coming to us, and there's a lot less competition because a lot of the bank
Blackstone's
lenders.
getting in. So
What was that?
Blackstone's getting in.
No, but so the Blackstone coming in is great, again, because they don't compete with us. right? What it does is it legitimizes the asset class. So now folks that were like, hey, this
So the
sounds
investment
really...
consultants are returning your call now?
Oh yeah, I mean, now they're calling me.
Okay.
Seriously, I mean, it's great. It changes the tune when Blackstone says we're dropping $2 billion on this, and they go hire a bunch of people, from that we know. So but forget about venture debt. I think this is a great opportunity for direct lending in general, and folks that aren't in the asset class really should be looking at it. I think leverage loans is a great place to be, to Steve's point, but private credit, niche strategies that have low correlation to the market, floating rate structures, senior secured, they give you everything you want. They're inflation hedged, they're low risk, right? They're a good diversifier. I mean, it really is probably the best place to be in the market right now.
The other thing that I left out is, to Zach's point, in this vintage, we're charging, pretty high rates, right? So the companies actually have an incentive to take you out as soon as possible when the market recovers. So our loans are not going to be outstanding for 6 or 7 years. We tend to see 25% repayments per year, but a company that's paying anywhere from 9 to 13% is going to pay you back as quickly as possible and refinance. So from an investor's perspective, you're getting cash flow a lot quicker.
Dan, do you have any additional comments?
I would just say leverage loans is a huge opportunity. It kind of goes back to the innovation point. Thinking about just private debt markets in general, that wasn't even an asset class just 10 years ago. That you've seen just rampant demand for those products, and it goes a lot to what environment that we're in today. So I think that's going to continue to see a breakout further into private debt.
Got it.
One quick thought, just big picture. If you think about fixed income, there's two big risks that you think about. Credit risk, which is the risk of default, and then you've got interest rate risk. And a lot of people don't, even though it seems fairly simplistic, a lot of people don't think about the interest rate risk, or certainly they haven't in a long time because rates were so low, so it wasn't really a risk. Rates kept going down, which kept meaning you were getting a tailwind helping your investment performance on the fixed income side. But now we're in the opposite environment where rates are going to keep going up. And so you have to think about, okay, how am I hedging my portfolio? Or even if you're not hedging it, how am I managing risk on the credit side and on the interest rate side? And the reason I really like leverage loans and other private credit strategies that have floating rates is that takes away that interest rate risk, right? So now you only have to worry about credit risk. And if you're senior secured and you've done the fundamental credit analysis on these companies, the credit risk, I think, is actually very manageable. Yes?
Can you repeat the question, Zach?
Good question from James Perry on, are lower equity valuations helping us as an underwriter? And the answer is yes, because basically a lot of companies that raise money from VCs raise it at a pretty high valuation. And the last thing they want to do is do their next raise at a lower valuation. That's called a down round. So imagine you did a round in 2021 at the peak of the market. And quite frankly, the probability that you were overvalued is very, very, very high, right? Now you come back to the market, and the market's sold off. Sentiment's changed. People don't want to make allocations as easily. They don't want to write checks that are as big. So you're worried because as a founder, you don't want to go out and raise money at a lower valuation. It looks really bad if last year you raised money at a $500 million valuation, now you're going to market it at a $200 million valuation, right? So where debt can really play a helpful role is we can lend to these companies without having to go out and put a publicly disseminated valuation on them. Because we don't actually really care exactly what their valuation is. Because that's a funny money number. Like, I really don't care if somebody's like, oh, I think this company that's never made $1 is worth $1 billion. Yeah, right. No, it's not. Right? We're realistic. We're fixed income lenders. We're looking at their revenue and their cash flow and their asset base. And what we can do is we can lend them money based on our analysis of their revenue, their cash flow, and their asset base without having to go out to the market and say this company is worth 50% of what it was worth last year. So in other words, it allows these founders to not have to do a down round, and it helps them save a lot of face in the market. And just a quick point, venture debt is not only used because of the equity dilution and minimizing that. Think of it as just growth capital that's cheaper than equity. And it also just provides that extra like catalyst and stimulus to help these companies extend their runway and get to that next big milestone. So what we're doing is we're not funding the company in its entirety. We're not underwriting the full capital raise, in other words. We're typically coming in conjunction with equity, and we're saying, okay, we're going to do like 20 to 25% of your total capital raise. It'll save you that marginal dilution, and it'll give you that extra capital to facilitate growth so that you can raise at a higher valuation, or you can reach a milestone that will enable you to exit, whether to a strategic buyer or potentially through an IPO.
So in this environment, most definitely. So something I learned early in my career is that just because private equity fund X thinks a company's worth $1 billion doesn't mean it's actually worth $1 billion, right? You have to do your own valuation work and do your own credit work there. But when you see lower valuations, you tend to see lower leverage levels as well, because as I said earlier, you tend to see kind of that 45 to 50% equity contribution. So you're lending less, right? You're never going to lend 80% LTV on a company. So you're lending less. There's less debt on the company, less strain on the cash flows of the company. So it does help from a credit perspective to have kind of a lower valuation there, as long as you have a capital structure that's in line with that.
And as a follow-on, something more administrative, but very important to many folks in the room here that are investment fiduciaries on pension boards, maybe you can speak to benchmarking. You've talked a lot about innovative ideas and strategies. What is the benchmark you would suggest that they would utilize for the strategies you've been talking about? So I'll start with Steve first here.
Yeah, sure. So I think a lot of the benchmarks are some of the return profiles that I showed earlier in terms of the liquid leverage loan market, the high yield market, and also what your overall fixed income allocation is. So how much do you have in treasuries, emerging markets debt, investment grade debt? So private credit really is a good proxy or a sub-allocation that you should use in your fixed income bucket and compare it to the returns that you're getting elsewhere. As Zach said earlier, because most of our debt is floating rate in nature, the duration is practically zero. So we don't care if rates move up and down because we're taking advantage of that. So you don't see a lot of the volatility in price that you did see in a lot of the fixed rate investments. So you really should benchmark our returns versus your other fixed income investments.
So you're part of a broader fixed income strategy.
Yes.
And that fixed income strategy should be like a Barclays aggregate, for example, but this is a key component to opportunistic and opportunity to add value.
Exactly. Well, you're going to generate a great deal of alpha by going to
and that's positive alpha, not negative.
Positive alpha within the alternatives in fixed income.
Dan?
Yep. When you're doing some sort of a benchmark analysis, benchmark review, part of it is just where am I taking assets from to invest in this new opportunity? And what is the objective? So not only is it just within fixed income potentially, so like Steve is saying, thinking of it from a broader fixed income allocation, but what truly is the goal? I mean, we're here talking about inflation assets, and so shouldn't CPI plus something then also be part of that conversation? And that's over the longer term, you'll know, well, has my fund actually completed its objective? So in some instances, you have to think about that as part of your benchmark for those absolute return strategies, absolutely.
And in this room, the actuarial interest rate assumption is the looms large, so indeed.
One quick thought on this, and Steve had actually touched on this on one of his earlier slides. In the private direct lending space, an index that I think is pretty good is the Cliffwater Direct Lending Index, a CDLI. They essentially look at all the returns from what's called BDCs. These are publicly traded companies that basically are publicly traded loan portfolios, in essence. So the CDLI looks at, I don't know the exact number, call it 80 to 100 of these BDCs, and that's a very good benchmark in the private credit space. There's no, but to Dan's point and to Steve's, I mean, it really depends on a lot of things. I mean, there's no like perfect benchmark.
So you're saying it depends?
It depends, but the CDLI is good for private direct lenders.
All right. Great. Additional questions? We got about 10 minutes or so left. We've got several more questions that I can lead further. Well, I know, we got a question? Yep. Right inside, yes. I've got a lot of ideas and I can share them, but I think the panel would love to speak 100%
up on this. Is good.
There you go. But don't do that.
No, we've seen.
What typically do you see?
We've seen some funds, some large state pension plans be very aggressive because of the strong cash flow characteristics. As Zach said, in the private credit world, we have no reason to hold on to the cash, so we're returning it on a quarterly basis to our investors. Our fund, for example, is paying out 9% annualized yield. But what we're seeing a lot of our LPs allocate is approximately 5 to 10% in the private credit
So
space.
a mid-single-digit number sort of rounds out to get a total return of something like 7% of the overall portfolio.
And we, as I showed earlier, kind of the average returns in the CDLI over the last 15 years has been close to 10%. Very low volatility, and we are paying a lot of current income. So the current income you're getting is dramatically outpacing what you see on investment grade and treasuries right now. So from a cash perspective, it's very attractive. As you have to make payments under your pension funds or your healthcare funds.
Excellent. Dan?
Yeah, I would say, especially if we're talking about a long-term pool, think about 25-30% towards just that alternatives bucket in general. Breaking that down then between private equity, private debt, you're talking about maybe half of that, and then within half would go towards private debt and some of these other different strategies like a leverage loan type of a product. But that's about as big as we would really recommend, given the liquidity constraints you'd really have to consider, again, if we're talking about for a long-term pool.
Also you have to work through size of the overall plan, the sophistication of the underlying investment fiduciaries, and the level of sophistication the staff and consultant can bring to the table as well. And Zach?
One thing I'll add to that is a good example, positive example, is looking at the pensions in Canada, who are actually,
All right.
we love Canada.
We're going to go there. All right.
But in all seriousness, they started allocating pretty heavily to private credit well before folks in the U.S., and their performance has kicked the butt of the
Even
U.S.
in Canadian
honestly.
dollars.
Yeah, and a big part of the reason Canadian pensions have outperformed their U.S. counterparts is because of this over-allocation to private credit. So this is not something that we're thinking about theoretically. You've got our neighbor to the north is a perfect case study, and you see that it works. So I think what I'm seeing a lot of, I talk to pensions every week, but I also talk to a lot of other institutional investors. There's a big push now from RIAs, endowments, and foundations as well, outside of the pension space, to move into private credit. And I always ask them, well, what do you like about it? So I can tell you all what they like. And they like the fact that it's floating rate, most of it. And they like the fact that it's lower volatility and you're getting real income. It's not paper IRR. So this idea of like somebody's IRR on paper, their return that hasn't been realized yet, to me that doesn't mean anything. Like I don't care what your fake number is, right? I know think about how many people you knew that were paper millionaires in 2006 that were worth zero in 2009, right? But if you're getting a cash coupon every quarter, that's pretty solid, and I'm surprised that more consultants haven't come around to this in the U.S. honestly, because if you're thinking about like longevity of a relationship with your clients, it's hard to let go if you're producing a 10% return every year, like clockwork, which is what private credit has done for 2 decades. I mean, no one's ever going to fire you for getting double-digit returns and cash income every quarter, ever.
That's a whole other topic, Art, for another panel. Any other questions? We've got about 5 more minutes or so before the next panel. Yes. All right. Is there a question there? Maybe you want to follow on? No question. Right.
Well, just for those that couldn't hear, James made a great point, which is the higher the percentage of your return that's contractual, the lower your volatility of returns. And that makes total sense, right? If you're legally obligated as a borrower to make a payment each quarter and repay the principal, you're going to, unless you go out of business, right? And that's why debt's so great, because if you pick the right companies and you manage your interest rate risk.
That's the skill that you bring to the table.
I mean, there's a reason why a lot of folks have had big chunks of fixed income in their portfolio for a long time. I think the big change that's happening now is they're moving from true fixed income, i.e. a set fixed interest rate in like high yield bonds or investment grade bonds, to a floating rate note. or loan, right?
Yep.
And so they're both technically in the fixed income bucket, but they're very different in terms of their risk profile because one actually has a fixed rate, the other has a variable rate.
Yeah, and in our private credit fund, north of 80% of our returns are contractual in nature, so it's the quarterly interest that we're receiving. As I said earlier, we're charging an underwriting fee of 2 to 3 points, which go to the investor, so that's cash coming in. In many instances, if there's a prepayment on the loan, there's a prepayment penalty of anywhere from 1 to 3 points. And then our fund also takes equity exposure as well. We're not getting warrants. You don't see that as much in the private equity world, but we are buying equity alongside the sponsor and picking and choosing which ones we want to invest in. And those generally we're underwriting to 20% plus IRRs. We're not getting cash income from that, but we're seeing that on the back end.
And maybe as we wrap up, maybe more of a soft point. So now as the pandemic is becoming an endemic, maybe you can just describe how your work life has changed over the last few months. So how many days in the office, how your teams, what does that look like in 30 seconds each?
Yeah, sure. So after about a year and a half of working from home, last September we returned to the office full-time in September. So about a year, 5 days a week, which is a little unusual in New York. Most people are back kind of
3 days.
3 days. I heard of a firm that's working from home all of August. I would love to do that, but we've been back full-time for a year, and our headquarters has actually been back full-time since June of 2020. So they're in the suburbs of Boston and not as affected, but so they returned very quickly.
Dan, your life?
Yeah, I would say since March till earlier this summer, basically working from home this whole time. I would say, though, recently we've started to reopen our offices, but it's more of a hybrid. It's more the comfort of the employee because not everybody wants to go back. Some people love to go back.
Do you have mandatory days, like every Wednesday? Or
It really depends
based
on
on the
the team and
Yep.
how they function as a group. If they've been able to work through the last 2 years virtually, then great. If you need to be in the office because you're traders, then get back in the office. Or if you're like me and you have young kids at home because it's school's out, then you're back in the office because it becomes very loud at home.
Understood.
But
That's funny.
that's really where we've been at.
And Zach?
Yeah, no, I'm so excited that we're all back in events like this, and which reminds me, I wanted to thank the folks that put this all together. Art, great job as always. Jim Smith and the board at TEXPERS and the team at TEXPERS. I really think this is one of my favorite events. I probably spoke at 50 events in the last year. I've been like a road
TEXPERS
warrior.
last year was one of the first events to
Yeah.
go fully open in Austin.
Yeah, that first TEXPERS. It was that last May or
That
April.
was May, yep.
I mean, that was a killer event. That was a great job, Art.
So we're
Awesome
going to
job.
end it on that note. Thank you, everyone, for your questions, and look forward to further discussions over the cocktail hour and the breaks. And we'll see you all soon. Please join me in thanking the panel.